Are we rolling?
Hello, everybody.
Ciao, everybody. How are you? How are you?
Guys.
That's good.
Good, good. It's summer
Okay,
here.
so yeah, it's fantastic. So I think it's time for our super cool panel. Obviously, I'm moderating, so I like to say that. But also, I'm very privileged to have today with me three extremely experienced and cool guys from the VC ecosystem that will help us discuss the changes and everything that is happening into the venture debt space. So the title of our panel is Why Venture Debt is Gaining Momentum This Year. So I'm pleased to have, I'm sure you recognize them because they're famous in the ecosystem. But let me just introduce them briefly. We have, I'm going by order of alphabetical order. So, I'm not going to hold to the wall who I'm introducing first. So we have Michael Treskow, partner at 8 Roads. We have Roland, Dennert, managing partner at Cipio Partners, and we have Stephen Nundy, partner at CTO at Lakestar. So shall we start by having a few minutes for you to introduce yourself? Shall we do like 2-3 minutes each? Shall we start with Michael, Roland, and Stephen?
Let's do it. Thank you,
Yes,
Donatella. Pleasure to
you're
be
welcome.
here. I'm Michael. I'm with 8 Roads Ventures. We're a global VC firm focused on scale-up stage investing, so Series A, Series B plus. We are global in nature, started about 50 years ago in the US, and since then expanded to London, where I am, focusing on European investments, but also teams in India, Japan, China. It's about 100 of us worldwide, working with about 300 portfolio companies and managing about 11 billion. And we focus on companies that have built a product, found product market fit, and are now in a scale phase where we're hoping to help the teams maximize their potential. We typically invest 10 to 30 million upfront, and it's typically a Series A to Series B round. We are industry agnostic and we are geo agnostic. I personally am in London and focus on working with our European and Israeli companies. I have a pure technology investment background, have been doing this for about 10 years now in London, and was doing the same thing before that in San Francisco and New York. That's me. Thank you, guys.
Thank you, Michael. Roland, the floor is yours.
Thank you very much. So hello, everybody. My name is Roland Dennert. I'm managing partner of Cipio Partners. We are based in Germany, but we are a European growth investor. We invest in software companies and deep tech primarily, so some hardware businesses, but the majority is more on the software side of things. We have a pan-European mandate. Occasionally, we invest in Israel. Probably our most active markets are Germany, obviously, where we're based, in France, where we have a lot of our investments, but we invest in the UK, have assets there, in the Nordic countries, Ireland, and so on. We quite actively start looking now at the Baltics and Eastern Europe. That's an area we haven't done much, but think is extremely interesting and will be very promising in the future. So it's something we take a large interest in. We invest in companies that are typically, I would say, EVs 50 to 200 million. And like to write tickets of, say, 10 million initially with some reserves for follow-on in funding rounds that would typically be 20 to 50 million. We're fortunate enough to have raised a new fund last year, so we are quite actively investing and waiting for some great opportunities in the current market. Nice to be here.
Thank you, Roland. And Stephen, off you
Hey.
go.
Hey, Donatella.
Ciao, ciao.
Good to see everyone. So we're a pan-European VC. We've got 3 offices in Berlin, Zurich, and London. I look after the London arm, but we invest right across Europe, so we're kind of agnostic to where the offices are. 80% of our capital, we invest in European founders. We focus on an early fund, which is pre-A&A, and we've got a growth fund, which is for the latter letters of the alphabet. We write checks of anything between 500K up to 50, 60 million euro. And when it comes to the sectors, it's mainly software across all the different theses that you could imagine a multi-stage, multi-sector fund would. I think one of the things that we focus on though a lot is sovereignty and the importance of backing European founders when it comes to topics of independence and trying to avoid monopolies. And I think that's been our strategy over the last 10 years, and it's never been truer than in the last couple of years to really make sure that we're backing European champions. So that's a little bit about us. Good to be here.
Thank you. Fantastic. Thank you, guys. As you can see, we have a fantastic international panelists, and then let's go into the nitty-gritty of our topic. So first and foremost, I mean, I cannot avoid mentioning that in light of the storming equity fundraising markets, especially we're talking from a point of view of a startups, obviously. Why do you think the startup should raise now rather than putting off for milder times? I mean, we're talking about venture debt, but of course, I think is as an equity issue now, because I see venture debt and equity even being even more a complement to each other than we have ever been. So I'm really interested to hear your point of view from that. Shall we start? Who wants to start first? Come on.
I can take a first stab at it.
Okay.
So I mean, I think the first observation I would have, we see that in our business, and I hear that from a lot of people I speak to. Currently, the market really doesn't quite work, right? The transmission is broken somehow, or the right gear is not engaged. And the question is, why is that the case? Is it because the VCs don't have money any longer, or is it because companies don't want to go fundraising, or what's the reason? And I think the main reason today is it's a bit of a standoff on terms, right? The better companies want to defend their last round, and get at least flat rounds or even slight up rounds, and try to avoid a down round at all cost. And investors only can be selective and only really want to invest in the better companies in the first place, but also expect somewhat of a down round to adjust to the new environment. And that somehow doesn't quite work, and something will have to give. So I think from a company perspective, how do you respond to that? My advice would be to, if you know you need to raise or want to raise money in the next 12 months or so, I would probably do it rather sooner than later, because once that transmission starts working again, I think the activity level will be quite high, and funds will very quickly be at sort of capacity limits, right? Because while we may have the money, we can only progress a certain number of deals in a given time. We can't do 3 deals in parallel. It's just not possible. So I think there will be an effect of...
Roland, it's a good problem to have, though.
Yes, but I'm now speaking from a company's perspective. Right now, it doesn't really work, but when it will, a lot of companies will want to raise, and funds will be sort of congested, and then the raising will again be delayed, not because the standoff, but because sort of the capacity is just not there. And then likely you will have to wait even longer. So I would probably take advantage of the fact that we all want to do deals. I'm pretty sure that's the case for the people here on this call. We all want to do deals, and we have probably been doing fewer deals this year. That's certainly the case for Cipio. We have been doing fewer deals this year than we would have liked to. And I think there's an opportunity for a company to try to cut through that and get your round closed rather sooner than later.
So, Steve and Michael, do you agree with this overview from Roland? Would you add anything to it?
Yeah, I think.
And then I'm gonna spice it up.
Yeah, the other thing I'd add is, look, you can't be penny wise, pound foolish, right? So the best entrepreneurs know that probably in this environment, the valuations aren't going to be what they would have enjoyed a couple of years ago. The pendulum has swung the other way. But fundamentally, if they are running a business that has an opportunity set ahead of it, and that opportunity set needs funding, then it's now is as good a time as any to secure the right amount of funding at a reasonable level to allow you to continue to grow into that opportunity set. If you're optimizing for interest rates or optimizing for a better valuation, I think that's a foolish game to play. Most companies, if they're going to have that exit velocity and they're going to get to superstardom, perhaps they're going to go through 4, 5, 6 rounds of funding. And you can't assume that every round of funding is going to be a mega up round, right? That is what I guess history has taught many young entrepreneurs over the last kind of 5 to 10 years, but that's just not the reality if you look over a longer cycle. And so the entrepreneurs I speak to kind of get the fact that maybe this is going to be the one where you have to take a you have to swallow hard, take a deep breath, and do what's right for the company rather than do what might look good on LinkedIn or on Crunchbase or in Sifted. And so, I'd say it comes down to fundamentals. If your business is ready to get to that next stage of growth, then you have a responsibility to your employees and to your existing investors to do that. And maybe the round after this one is going to be the one where you see a nice healthy uplift. And over a long cycle, it works itself out.
But that would be together. You're talking in as a complement, equity as a complement of venture debt. You think?
I'm talking about both. I'm talking about both, right? Whether you're taking an equity, debt, equity plus debt now, all the different permutations. We can talk about the makeup and mix of what the perfect mix is. But I would say that the terms may not be as favorable as they may have been 2 years ago, but you're still trying to push forward with your business. And so if the fundamentals are good, then keep going.
So basically the key issue here is runway until things stabilize. It is what I'm gathering for what I heard from you both. And Michael, what do you think?
I agree. First and foremost, I think, Donatella, I mean, there are two reasons for a startup to raise funding. One is to extend the runway because they're out of cash. The other one is because they see opportunities to invest that cash at an attractive return, right? Be it by investing in growth, be it by acquiring a competitor. And in both cases, the primary question is around that reason for raising. And then the secondary question is around the timing thereof, right? If you today do not need cash and you do not have good opportunities to invest excess cash above and beyond maintaining the runway, it probably doesn't make sense to go out and fundraise, right? Because as Roland said, the environment is not great. And we all kind of talked about the reasons why that is, but also why would you dilute yourself without reason? Now, if you need the cash or you have a great opportunity, something came up, you have a project that you can deploy towards, then you have to be pragmatic, right? And then you have to say, all of us, we're not here to time the market, right? The market at this point, it is what it is. And some companies got incredibly lucky and were able to raise at very nice valuations in 2021. And other companies were maybe less lucky. I mean, such as life, right? Fundamentally, we're not, investing and running companies is not about timing the interest rate market, but about building a good business.
Thank you, Michael. I agree. And but then I thought it was quite interesting, and Stephen mentioned now it's not the environment where everybody's aiming for the crazy up round constantly. And he mentioned that you should be realistic and see and raise at the valuation that is appropriate for the time. So if we go in a similar vein of what we have discussed before, how have you as VC funds alter your view of venture debt in the current macro? So do you see additional use cases? For example, in our case, we have seen an increase of M&A activity as a use of venture debt. As you know, there are certain use cases for it. So what is your view? Is something has changed? Do you like us even more now? Do you need us even more now? So what is your view? I always love you anyway, you know that.
And so do we, absolutely. And maybe let's start by structuring what use of venture debt you have. I mean, the way I think about it is there's a use for M&A, right? If you raise capital and because you're not quite bankable, you can't go to your local bank and get it at 4%, 5% interest rate. Well, you go to venture debt, but you essentially do it to fund acquisitions. That's one. Then you can use it in parallel to equity. I raise an equity round of 20 and I put another 5 of venture debt on top, which sort of marginally extends the runway because I probably have to start paying back some of it, but it gives me more volume, right? And then I can use venture debt instead of equity. Instead of doing a round, I can raise some debt and maybe push out the fundraising date by 6 months or 9 months or 12 months. That's how I would think about it. In the current environment, the first use case is great. And so I'm not surprised, Donatella, that you see more of that use, right? I mean, generally speaking, if you have money today, there are great opportunities to buy very interesting, good companies that might have been very successful in a different environment, but now find it very hard to raise beyond their Series A, right? And the best will, but some won't, and they still have good technology, good people. So if you're a broader company with a good platform and enough financial resources, fantastic add-on acquisition possibilities, and if you fund some of that with venture debt, it can be very value accretive for your business. So I think that's a great idea, and I'm not surprised you see that. Expanding a little bit around and maybe replacing some equity by a bit of debt, I think also can make sense, right? If you are more constrained by the market of how much equity you can raise, maybe adding some debt will give you more volume. So I think that's also a good use. And then the last one, replacing equity by debt, I think that's a dangerous one, right? That's maybe the one that people are tempted to do because they don't want to have the price, they don't want the down round, they don't want the tedious process, and so maybe raising 5 or 10 million in venture debt and kicking the can a little further and hoping for better times is the sort of the easy idea. It might not hurt today, but it could come back and haunt you in 12 months when you do have to raise. And not only you will have to raise for your own burn, you will also have to raise the money to pay back the debt, and that may make the barrier to actually getting a round closed even higher than what it used to be anyway. So that feels comfortable now, but it's like eating a burger, right? At McDonald's, it sort of feels comfortable, but it's not good for you.
No, exactly.
And so I would advise against that third option.
Honestly, Roland, I would advise against that as well, that situation, because frankly, to me, the only situation where what you describe would make sense in terms of replacing equity, because to me, most of the situation is a complement to equity. The situation where I would, it could potentially replace equity and mainly use as a tool to reduce dilution is a bridge to profitability or a bridge to an exit, when both of them are clear.
Agreed.
In any other situation, it's too risky. I wouldn't advise any company to do that myself. So, Stephen, Michael?
The only thing I'd add on to what Roland said is CapEx costs, right? And there was, for those of you who've been watching the news, there's been a lot said about the Mistral round that's just happened out of France. And, is that equity round really, paying for NVIDIA chips? Look, whether say what he will, hopefully the team does very, very well. But I do think you've got to think carefully about what are you using equity for and what are you using debt for, especially in the world that we're moving towards, where new compute models are coming out. AI is the buzzword, and I think it will be for the next decade. And what are the right financing instruments to finance different parts of your growth business? Because, as you say, there's a complement here that if you get it right, then you can protect yourself from dilution, but you've also got an asset-backed kind of security there in many respects for the debt provider.
Yeah, and also works for us as investors, because we all have an hurdle rate. So we always, it's good to have someone else to put more cash on a winner, or one of your portfolio company that is a winner, because then obviously you can reserve more cash later to support them. So this is also something to think about. Michael, any thoughts on that?
I mean, echoing, of course, what the guys have said, I think fundamentally the thing that has changed probably a little bit as we think about venture debt is it's going back to where it was before, right? So we had a moment around 2021, early 2022, where the cost of equity was so low that debt as an instrument was not as appealing, right? And we're now reverting back to the original theory of saying you have different capital structures that make sense. And as Ronald said, I think it's dangerous to try to use debt as equity because it has to be repaid at some point, and that's obviously your business. But if you do it as a complement, and as a result, you're expanding your fundraise amount. That is something that we were seeing a lot of and recommending in 2019. And that's something that's coming back now because it makes financial sense.
Yeah, and I couldn't agree more. And you know, guys, I'm totally with you on. I would never push that on in situation where is replacing equity doesn't make sense, because you know, from your points make total sense. But then if I look from my point of view, I mean, I'm always I'm the boring one. I'm looking at the sort of what can go wrong more than you do in a way, because we have a different risk and return profile. So I think we cover pretty much when we shouldn't sort of us going for providing venture debt to certain to company in a certain situation, and I think we are totally agree. And I think the other thing that I would like to know from you, in view of the current environment and how things have changed recently, is as an investor in a company. So what make you say yes or no to venture debt, keeping aside all the use cases that we already discussed and so on? So is it still a situation of size, burn rate is too expensive, is senior secure? Because in view, and I'm gonna go controversial later on if we have a little bit of more time, and I just refrain very hard to call myself ex BlackRock. So I'm going to just deep into what's happening in the venture debt ecosystem as well in a moment. But in your view, what would stop you from saying no to venture debt, considering also that the pricing has changed and has come more normal? I know I would say that, you tell me, but still. So.
I would probably say it's more expensive than more normal, but no.
Yeah, you would say expensive. I would say normal, as normalized.
No, I think honestly, I think the key question is, what do you use it for? How do you spend it? How do you create value with the money you raise, and how do you pay it back, right? I think those are the key consideration. Then obviously with interest rates, the cost of venture debt will also change a little bit, because your refinancing cost changes, right? And so it's just normal. And you have to run a bit of a competitive process, right? And the good thing is, in Europe we have more and more providers. 10 years ago it was pretty few and far between. Now we have more and more providers. We're also slightly similar but different forms of funding. We have revenue-based fundings. We have people that are specializing in SaaS companies and sort of back the revenue stream from these SaaS companies, and so there's alternatives. So you just have to get a competitive price, speak to 5, 6, 7 people, and get the best deal.
5 to 6, 7 people. Roland, be nice.
At least 10.
How many people you're gonna get me compete against? Goodness me. Okay. At least I know now. So, yes, yeah, go on.
Just give us the best offer first, and all is good.
Yeah, I tend to do that, you know me. And Stephen, Michael, what would is something that you really don't like? Apart from the people, obviously, because it's obvious that I'm one of your preferred, I would say. You know.
Yeah, we take speed.
Interesting. I like that.
So, you know, one of the things that differentiates a good experience, typically when these conversations happen, they may not happen at the right time. There may be ones where speed is of the essence. You've got the equity holders kind of there because they've been deep in the business for a while, and you need to bring the venture debt kind of provider up to speed. Them getting their heads around and really understanding the business and asking prudent questions, not daft questions, is something that taxes the founders in the same way as you wouldn't want a founder to spend time with a VC who hasn't done their homework, doesn't understand the business that they're investing in, has no sector expertise, doesn't understand the market and the market movements. The same is said for venture debt as well. And so that would be a reason why sometimes I find that CEOs are shy. They feel that there's a lack of understanding of their business and a lack of depth in the venture debt community. And so I think that's an area where I think you guys have upped the game over the last few years, but I think it's still a factor.
I take that. Thank you. I take that.
I wasn't talking about you. I was talking about some other great venture debt funds out there. We're going to get to FTP in a minute, right? But you know, joking aside, you know, I think that's where I think the venture debt community has upped its game, but I still think there's a gap between venture debt and VC, and CEOs worry about that because they don't want to get distracted for too long.
Okay, but before I hear that, I'm very interested to hear what Michael said, but as well. But don't you think there is a balance? To me, speed is probably speed of execution. What I think it would be is very valuable when you come to the situation where you have a signed term sheet and you get things done and it's done efficiently and so on. But when you, and I'm still for speed anyway, but from what you're saying, you still expect, I would hope that you would expect a venture debt fund that would become a partner with you and work with the company for at least 3 years to really understand the engine of the business of your portfolio company. And in order to do that, you would expect them to just spend time to understand the business. And by understanding the business, at the same time, you build a relationship. Yeah. So this is what essentially you're saying, right?
Yep. Okay. But it's about being efficient in that process. You know, the start to end time is one factor. It's about how many meetings, how many touch points, how many education sessions have to happen along that journey. That could be taxing if the venture debt provider doesn't have experience in the sector that they're being asked to evaluate. And I think sometimes it's better just to say, this is not our bag. We've not done something here, you know, rather than trying to be a fast learner.
Yeah, totally. I agree. Michael, what is your view, experience on that?
I think it's very similar to when we evaluate new equity partners joining a company, right? First and foremost, this relationship with management, right? And that can be, you know, all of us have different ways of building that. It's an understanding of the company and excitement about what the company is ultimately trying to build. Ideally, you would be able to add a bit more than cash. And last but not least, you want to do all of it quickly and with relatively straightforward terms, right? And I think the latter point is probably one we haven't talked about, but yeah, everyone seeks simplicity here and alignment of incentives so that there's not a scenario when one party thinks that this is a great outcome and others are unhappy about it.
Yeah, totally. I couldn't agree more. And so shall I safely assume that all three of you pretty much value the building of the relationship? Because I strongly believe that there is in terms of venture debt ecosystem, there is space for everyone. So I don't have any problem with competition. The problem I mean, it's not really a problem, but the situation that we had in Europe for a long time is the lack of options. So what Roland said about putting a competitive situation or competitive offers in front of his portfolio companies, I don't think you had an enormous amount of choice in terms of people that you like, that you know how they work and so on. So how much do you value a competitive landscape versus a relationship that you built over time with people that you know how they work, that you know how they act in a difficult situation? Because everybody's happy when everything goes well. You see the real people also within your VC ecosystem when things are not working in the right ways, where you see the true color of your partner.
I was going to raise that point. I think, in particular, in the relationship with the debt provider, if everything goes well, you can probably work very well with every firm, right? I mean, you get 100%. Your money, you pay it back, it's no problems. everybody will be happy. But we all know that things sometimes don't go quite as planned. Companies take longer, need more cash, and maybe fundraising is delayed or whatever might happen. There's always problems, right? And then you need to work with your debt provider and find a good way to solve the issue. Obviously, respecting
Sorry to interrupt, Roland. I'm not talking necessarily about the workout, because during the life of a company, a lot of things can happen, is ups and downs, which I would expect VC, a venture debt provider, to work together to resolve the issues and just get the company back on track. This is what I'm talking about, not necessarily
exactly. I'm doing the same.
Oh.
Once you get to a workout situation, it's already a problem, right? You never want to be there, but the company may need some intermediate financing on the way, and the existing shareholders decide they can do something, and the debt provider decides they can maybe reschedule something, and there's sort of very collaborative arrangements to make sure that the company can be successful and everybody is winning in the end, right? And I think if you had experiences with firms where that worked well, and to be honest, I think most players in the European market understand that this is a long game, and they need to build the relationships and work with the equity investors. Then that gives you confidence that the next time you raise money for one of your companies with that provider, then you probably have a good partner again, and things should go well again, right? And I think that's more important in the end than 0.5 percentage point of interest rate, because frankly, that doesn't really make a difference. You want to have a competitive deal, but you don't need to have the absolute best deal. But working with the right partners that you have trust and a good relationship is very important, and it's clearly more important than the pure financial side of this. And if somebody misbehaves, I mean, I think that can really kill their business, because if you had once a really bad experience with somebody, I can guarantee you we would never let them invest in any of our companies again, because we would be too worried that it could become a problem.
Yeah, I totally agree with you. Stephen, Michael, well, what is your view on that in terms of relationship and the importance of that to choose your venture debt financing partner?
If I talk about the last couple of years, maybe I'll turn the question: what's frustrated me about some of the
I like that. I want to know that
providers. It's the global ones which are schizophrenic in their regional attitudes, and they don't have a universal policy or strategy as to how they treat the US versus Europe. That always, to me, is a head scratcher. Yes, there may be different interest rates in Europe versus the US, but kind of, isn't that the only difference? Like, is there really a need to structure things, and the risk appetite is different in one region versus the other, where fundamentally you have two companies doing exactly the same thing on two different sides of the pond at roughly the same levels of revenue? Why are you structuring things differently? And so I think that's kind of smoked itself out with some of the upheaval over the last year or two, where those differences have existed. And that's frustrated me, because when companies present themselves as being global, and then actually they're not, they're just hyper local with one banner, I think that's that makes you question then why go with a global player if you don't get global treatment.
Yeah, I couldn't agree more. Michael, did you have the same experience?
Yeah, I think we all know the actors that Stephen is referring to. I think, going back to your original question, I think the personal relationship with management is super important, but so is competitive pricing and terms, right? And so ideally, what we would love to see is, the one or two providers who built up the relationship with management over time, but then are also competitive as dictated by the market, right? So I don't think, I would never go as far as recommending a company to just forego a competitive process, but I would strongly urge them to consider the relationship that they've built with a particular fund and the fund's prior history, in particular in a downturn situation, to take those into account and weigh those quite heavily.
Yeah, I'm totally with you on that. And as we have a few more minutes, I have to touch up on this, I'm afraid. So what does the collapse of Silicon Valley Bank means for the ecosystem, in your opinion? We have we have personally seen open up of geography that before I thought, okay, guys, let's not concentrate on origination in the US and Israel because it was just super competitive. Banks were doing crazy things, and I personally, as a matter of principle, I stop at crazy. So I'd rather pass and let someone else doing the crazy. I concentrate on something better. But now I've seen an opening up of, I don't know if it's because of that, of some of the players, unfortunately, not being in the ecosystem anymore. What is the, what do you feel is your experience? What do you think about what's happened with SVB? Surely impacted you on not only on the venture debt side, but on so many levels, right? I think it's something that is still very current. It would be good to have for our audience your opinion on it. And this is not to denigrate anyone. It's just to understand what's happening in the ecosystem is a fact, and how the ecosystem will recover from such a shock. Essentially,
I think this the shock that we saw was similar to what we saw in 2008, where people were blindsided by single point of dependency within their cash management programs. Back in 2008, hedge funds had one prime broker, and they traded through that prime broker. They had one custodian, and that's all great until that custodian disappeared, and then they took all your assets with you, right? And so those of us that were around in 2008 kind of saw this movie before with concentration risk with one provider. But again, if you look at the workforce now, probably 80-90% of the people that are working in startups were not working, during the financial crisis, and so this is a new phenomenon to them. And so certainly, and it's also, I think we have memory fatigue as well. It's not the question you ask a CFO is where do you hold your cash, right? We're talking so much about the forward-looking kind of KPIs. You don't spend a lot of time talking about cash balance management and working capital management. So I think that's really helped sharpen the pencils. I think everyone's now opened up a second, third, fourth bank account and are now diversifying their finances. I think most of us have probably already done that privately anyway, many years ago. So I think that's a healthy thing for the industry. I think now that we've seen, HSBC take on SVB and kind of they've done the whole rebrand last week at the beginning of London Tech Week here in Europe. At least.
I saw it, yeah.
Yeah, and I spent some time with that team last week, and now with the whole BlackRock Krios piece as well. You've got two Goliaths out there now in the industry. You're going to have BlackRock versus HSBC. It's going to be like Battle of the Titans, and I think that creates some interesting dynamics and opportunities for the regional players to be more nuanced and build that relationship, whilst these guys kind of tough it out at the top. I welcome competition, and sometimes you need to bring some of these things together in a more consolidated way to kind of clear away the noise and allow you to see, true differentiation between a global brand and a local player or a regional player, and the difference in value that both can bring. So I welcome it personally. I think it's a good thing for the industry. You need to kick up the arse sometimes.
No, I totally agree. I think it's a good change, and I think the core team has remained, as you probably met them at the London Tech Week as well. And now with Krios news, I think is a fantastic news for the asset class. Because it's just finally, after, this is just my personal opinion, but finally after years of educating the market, educating my, VC partner, building the relationship, because you are super important to me because you're origination, right? As well as fantastic people that I love to spend time with. So, but, I always had to educate both sides sometimes, and now with big players like this, put venture debt firmly on the global map. So it cannot be a bad thing. Do you? What are you thinking about that, Roland and Michael?
I mean, now we're speaking about the BlackRock Krios thing. I think it's sort of the coming of age of the industry, right? I mean, it used to be very niche, something new, emerging, nobody knew about it. This makes it quite institutional. I mean, if somebody with, I don't know how many trillions of assets under management like BlackRock thinks this is an important enough sector to buy into, it means that it's now a real part of the financial ecosystem and part of institutional capital. And so it's the coming of age. And I think it will be good for the overall ecosystem, because a BlackRock, of course, has very different means to put capital against these activities than an independent player. So I think we will see a new round of competition, larger amounts of venture debt becoming available for larger, more ambitious companies, right? And so I think that's good for all of us, because that's what we want in the European ecosystem: build large, ambitious companies and have the capital available to scale them.
Yeah, totally. I totally welcome that. It has to be a good thing for the ecosystem overall. Michael, what do you think?
I think we had a really exciting fire alarm test for a weekend.
Oh my God. Okay.
We all became treasury experts overnight, and that's not necessarily a bad thing going forward, right? So I think all of us now have the scar tissue and that memory that will ultimately strengthen the ecosystem, right? And the good news is it ended all just fine. And I think in hindsight, we're all going to be grateful for that little experience and exercise, even though I certainly wish I could have spent that particular weekend doing something else.
Totally.
Going forward, I think, as you said, so one, it's, this consolidation is natural, and hopefully it's going to create more stable partners for startups to work with. But also, whenever some players become quite large and institutional, startups typically see an opportunity to take a bit of the white space and gain an advantage by virtue of being a bit more agile or focused on certain domains or geos. And hopefully that means that new players are going to enter the market lured by this situation. And that's going to be a win-win for everyone as well, right? So I think net, I'm positive about it. All is well that ends well, and hopefully our portfolio companies are going to be beneficiaries of that.
Yeah, I'm sure all the ecosystem will be. I think there is one common denominator. What's happened, with SVB and now HSBC and the new team and BlackRock. In both situations, they need specialized teams. So, and that to me is key, and hopefully will just help the ecosystem, as we all hope, both on the VC side and on the venture debt side. So I think, as always, being Italian, I'm late. But there is, I've been told that there is a question from the audience. So, where's the question? Here we go. How would you rate revenue-based financing versus term loan venture debt? I don't want to answer this question.
I'll answer it. I think it's amazing. And there's a great company called uncapped.com, a Lakestar portfolio company. Go use them. They're the best one out there.
Can anybody mute Steven, please? It's his portfolio company. No, I know Piotr, and I rate Uncap massively. So, but can you answer? There is a difference between the two. So
there's a difference. I think
I'm biased.
There's a place for everybody.
Yeah, exactly. You're terrible. So, but do we want to be a little bit more specific in your experience? When do you think is? I think it's not a versus, dear Steen. Is actually a use for both in different situations. To be completely honest with you, because I know Uncapped, I know Piotr, I know the fantastic business that they built, but their solution is used in a certain situation, and venture debt is used in others. There are some situations where could be an overlap, but it's not necessarily one or the other. Steen, hopefully I answer your question. And then we can take it offline. You can send me an email and I can explain, and also Steven can explain more on Uncapped as well. Okay, so that was fantastic. I'm enjoying myself. I could stay another half an hour, but I would have to send you some champagne in order to also keep you entertained. And no, I'm joking. I'm actually no. Halfway. Thank you very much, guys. Has been very interactive, like I liked, and hopefully you enjoy yourself. And